this award, you can see on my mind where my mind is, will be Justin Kim. Justin Kim is from Derby, Kansas. His major is anthropology and visual art, and he also has minors in business and French. His academic career goal would be to enter in the Foreign Service. Some of his activities on campus would be the Office of First Year Experience. He's involved with orientation assistant and orientation assistant. He's on the Dole Student Advisory Board, Student Union Activities, Finance Committee for Student Union, also Student Alumni Leadership Board, Executive Vice Chancellor of Membership, and also he has been recognized as the Student Employee of the Year nominee for April in 2017. And he has other awards, but I'm skipping through them. Each of the recipients were asked to write a 250 or less essay talking about why public service is so important. I'm just going to do a highlight from Kim, from Justin, and he says, "It is through service alone that I have been afforded the incredible wealth of opportunity that I enjoy today at KU. My father immigrated here with his family as a child and grew up with very little. When he became an adult himself, he enlisted in the U.S. Air Force and served for 20 years. It is because of his service and the transfer of his GI Bill benefits to me that I am able to attend this university and fully pursue my various interests while I am here. On campus, I've served my fellow students by working to expand access to campus resources and the awareness of campus involvement opportunities. I hope to continue my father's legacy of service on the local, state, and national level, as well as international. And I hope by the end of my time, I would have done all I can." Justin Kim, the recipient of the 2017 award. And Justin Kim will be the recipient of the 1000 award. But what's important is that these four were truly outstanding candidates, and all four will work as a team on civic engagement and KU leadership during the fall when we put on our annual 2-year program. So it's extremely important. And I have to acknowledge our director, Bill Lacey, for this. Because when we look at the awards, we talk about outstanding students and how we want them to work together. And finances has never been an issue with him. If they're outstanding and he wants to do, I mean, he do worry about money, don't understand. But I would just like to say, when I present it, he smiles and go, okay. And I want to acknowledge that because our students are truly deserving. And another round of applause. But before I do that, I want the parents to be recognized. For Ashley's parents, David and Jerry Reese, are here this evening. Would you stand, please? And Justin's parents, Paula and Don Kim, are here as well. Thank you very much. Now I'd like to introduce our guests this evening. Tonight's interview will be conducted by the Dole Institute of Politics, Dole Lecture. Immediately following this program, we will hold a book signing in our reading room. Books are available by the entrance to the Institute from KU Bookstore, and our guest tonight has served as the 13th president and CEO of the Federal Reserve Bank of Dallas since September of 2015. He represents the 11th Federal Reserve District on the Federal Open Market Committee in the formulation of U.S. monetary policy. He was previously the Martin Marshall Professor of Management Practice and a Senior Associate Dean at Harvard Business School, and is the author of several books. Prior to joining the Harvard in 2006, he was the Vice Chairman of the Goldman Sachs Group. A native of Prairie Village, Kansas, he is a graduate of the KU School of Business, and he holds an MBA from Harvard Business School. May I please say, give him a very warm welcome, Mr. Robert Kaplan.
And if I just want to say thank you to the Dole Institute, thank you to Bill, and I want to thank particularly Scott Richardson and his wife Lee, but Scott worked, I know, very closely with you to arrange this, and so thank you, Scott, for bringing me back to Kansas.
Yeah, and this time, I was able to call you Rob last time you were here. This time I have to call you Mr. President.
No, you call me Rob.
So,
No, that's all
no,
right.
I'll call you Mr. President.
Yeah.
But anyway, let's start off. Talk a little bit about, we want to get into your personal background a little bit. Talk
Okay.
about your upbringing and some of your experiences here on campus.
Okay, well, okay, good. So I grew up in Kansas City, went to Shawnee Mission East. My father's a jewelry salesman, covered the Midwest. And so I went to every mom and pop town every mom and pop jewelry store, I should say, in most towns throughout the state, and he covered Texas. So I learned a lot about Texas and Kansas and Missouri, Iowa, and Nebraska. And I learned a lot about what it means to serve and to help people build their business. At Kansas, I lived at Naismith Hall for 4 years. I've made a lot of close friends, had a lot of fun, but most importantly, for me, KU, it's the only school I applied. I knew I was going to come here when I was 5. After listening to Junior Riggins, Bobby Riggins, Bobby Douglas, remember those years? Listening to those games during the late 60s. My sisters were going to apply elsewhere. I was going to come here. They wound up coming here too, by the way. And so, but I love Kansas. It was a great experience. It was the right school for me. Great teachers, great atmosphere, and made great friends.
Okay.
So it was fantastic.
Okay. How did you get started in finance? Why did you decide to pursue finance as a career, and how did you get started?
Well, so I was really not a financial person. Math, it was not my subject. English was my subject, and we were talking about this over dinner. That was where I was really great at. But my mom and my dad taught me about the market when I was probably 10, and I followed the market every single day from the time I was 10 years old. So I was less a finance person, and I was more of a stock market person and someone who wrote. And so the interest in the markets are what led me to Wall Street. It wasn't as much, financial engineering, balance sheet. I learned that, but it was really, and I still to this day, and it fits me well in this job I'm in, I love the markets. I love learning about the world, learning about the markets, because they incorporate everything. Sociology, political science, every subject you can imagine is incorporated in the markets, and I just think it's very interesting. So that was really how I got into being an investment banker, and then wound up doing some of the financially oriented things I've done.
Okay. And tell us a little bit about your time at Goldman Sachs, how you wound up there, what you did, what your various roles were.
So I started in investment banking, and I was in a number of different areas. The early days, the leveraged buyout business, it was called private finance in those days. I ran the high yield business. I was asked to go to Asia when I was in my early 30s, and I ran Asia for 5 years, from 90 to 95. I came back and ran the corporate finance department, then I came back, and then I ran the investment banking division, then I was asked to run investment banking and investment management, and I always had a inkling and knack for coaching and developing people. So I chaired the partnership committee of the firm, which did all the promotions and managing of the partners. And I chaired what we called the Pine Street Leadership Program, which was all our leadership development training. And it was the Pine Street work that got me thinking a little bit more that it might be fun to someday be a professor. But that's how I got started in talking about leadership.
Mm-hmm. Mm-hmm. And talk a little bit about your time at the Harvard Business School. I know you and I met in Cambridge at your office one day about 10 years ago.
So I did something that at the time was more than a little bizarre. In 05, I took a leave of absence. I was in the office of the CEO for the firm, and I'd been at Goldman Sachs for 23 years. And the business was becoming, and the street was becoming more trading-oriented, a little less client-oriented. And so I had a little bit of a wacky idea to take a leave of absence for 3 months and teach. And I had met a professor there named Nithin Noria, who later became the dean, ironically, who encouraged me, "Okay, you want to teach? Come teach in my group." And he was the leadership group. So I took 3 months, after a year of negotiating with my boss, who I sat next to was Hank Paulson. I took a 3-month leave of absence. I taught leadership, first semester, first year lead. with a teaching group. We each taught our own section, but you learn how to teach the case method, and I loved it. And the part that struck me even more was I learned more in that 3 months than I'd learned in a couple of years, and that scared me. And I went back to Goldman and I resigned. It was a difficult decision, and I stayed at Harvard, but that's what got me to go to Harvard. And I found where I never intended to stay. I never intended to be a professor. I definitely never intended to write a book. I had no interest in writing a book. I had no aptitude, I didn't think, to write a book. The more I got into teaching leadership and the more I did around the university, I stepped in the middle of crisis in the endowment. I helped with I chaired the sustainability effort for the university, and I got more and more and more into it, and I learned, it's like being a country doctor. You help more and more and more, not just students, but lots of executives, that after 5 years, I decided I had something to say, and I wrote a book, and then I wrote 2 more, and it turned out, to my surprise, to be a very natural place to be until the opportunity came up to go to the Fed.
Mm-hmm. Talk a little bit about kind of your thoughts on leadership and kind of your books that you've written about it, and take a little time to kind of go into some depth on this, because I know that it's a topic that is very important to you.
Yeah, so I'd say this half humorously. I got to Harvard. I always talked about leadership at my firm. I was always a coach, and to me, leadership meant taking ownership, acting like an owner, helping others, pretending this is our place. And my philosophy always was, in business, the bigger group we have, the bigger the group we have that thinks and acts like owners, the more successful we're going to be. So I tried to teach people, empower people to think and act that way. Fine. So I go to Harvard, and my main first impression was to keep my head down and keep my mouth shut a little bit and learn. And so I dug in and learned all the different frameworks and how you teach case method and all that. And I figured, listen, this is Harvard Business School, and they teach leaders who make a difference in the world. And what I learned after 2 or 3 years, to my surprise, is there's a lot of confusion about what leadership is. So I used to do this thing when I'd have executives. I'd talk to 50 or 75 CEOs, which I used to do a lot. I'd ask them to write down their definition of leadership. And what I found is you get 20 different definitions. Some people think it's about, let's point a direction and get people to follow. Some people think it's about, no, it's not about that. It's about just empowering others and setting the conditions that empower others. And I agree with both those. The dominant belief about what a leader does, though, which many of us have, which we don't admit it, is forget all that touchy-feely stuff. Are you making money? Did you have a winning season? Did you win the election? It's about results. If you generate results, you're a good leader. And you may laugh, but I assure you, in my business career, I looked like a whole lot better leader when I was running businesses that made a lot of money than ones that didn't make as much money. And so whether we like it or not, the tendency is to associate leadership with results. There's a problem with that, which is you better hope then that you're in a good industry with a strong tailwind and things are going well, because if you're in a tough situation and the business is not, as Warren Buffett says, if it's the difference between the reputation of the business and the manager, the reputation of the business is going to win, meaning if you're in a rough business, or a tough assignment, you may not be thought of as a very good leader. So when I realized at Harvard, there's enormous confusion about what a leader does. And so what happens is when people get in leadership positions, they don't know what to do. They really don't. And then they go back to archetypes they have in their head. John Wayne, Green Berets, or different people they've seen, they're not sure what to do. So I jokingly say to people, I came to the conclusion after 3 or 4 years that I couldn't do any more damage to the field than already existed if I just came up with my own definition and wrote my own book. And so I decided I'd be audacious enough to define it myself. And I did. I tried. And I wrote the first book, which was called What to Ask the Person in the Mirror, you're familiar with, was about, we won't go with vision, priorities, and alignment. It's about the blocking and tackling of management. I wrote a second book about how to reach your own potential. And then I wrote a third book about defining what is leadership anyhow? How do you define it? And my purpose is to demystify what leadership is and break it down into it. And I liken leadership, the best analogy I could give, it's like losing weight or getting in shape, which everybody in this group, no offense to anybody, has tried, and we're all trying. It's the kind of thing, there is no destination. I don't care who you are or how good your genes are. If you want to lose weight, there's no point. You're going to have to really work at it. If you want to get in shape, you're really going to have to work at it. And leadership is the same thing. And unfortunately, the idea out there, leader, you're either born with it or you're not. You either have it or you don't. Right? You either got it or you don't. I'm not that charismatic, I can't be a leader. And I try to shake people away from that. If you're going to be a leader, the number one criteria of an excellent leader is, are you willing to learn? Are you willing to work at it? And so what I spent years doing at Harvard with the books and the teaching is taking people who maybe were aiming here and say, you ought to aim here. You know, you can do better. Or for people who thought, I already know everything, shaking them up and saying, if you're not open to learning, I don't care what level you're at, if you're President of the United States, if you're not open to learning, you're in trouble, okay? And so my whole purpose was to shake all these preconceptions about leadership and get people to say, okay, I'm willing to work at it. I'm willing to ask questions. I used to tell it, leadership is about asking the right questions. It's not about having all the answers. And if you believe you need to work at it, if you believe you're open to learning, stop walking around like you know everything, because your people are going to think you're an idiot, okay? Hate to break it to you. And they're going to be a lot more confident if you say, I don't know. I need your help. I am open to learning. And then here are a bunch of ways to work at it. And that's what I spent 10 years doing, and giving people, in effect, permission. Because I'm not really a touchy-feely guy. And I gave people permission to say, you know what? It's okay to say, I'm insecure, I don't know, I need your help, I'm not sure, I need your advice. And I think me saying it maybe came across in some ways more credible than if I had just been taught my entire career. So that's what I did for 10 years.
Mm-hmm. Okay, wonderful. I'd like to talk about the Federal Reserve a little bit.
Yeah, let's do that.
And this is some of you I'm sure are experts on it, and I am not.
There is no such thing.
I am going to try to educate us all together here, and if you're an expert, you'll have to hold your questions, but in the Q&A session at the end of the evening, you can ask your complicated question. Let's start with, how did you get your job? How did you become president of the Dallas region?
Let me give the context for people. And by the way, for those of you who think, gee, there must be somebody here who's an expert in the Fed, I was in business for 30 years. I didn't realize till after I got to the Fed that I really didn't know anything about the Fed, okay? And my guess is I'm typical. There are 12 Federal Reserve banks in the United States. Okay, Kansas City, for example, is one of the districts. I run the 11th district, which is Texas, parts of New Mexico, and Louisiana. Okay, but there's 12 of us. The country's divided up. In addition, there's supposed to be 7 governors in D.C. So when you hear Janet Yellen's name, she is one of the governors. It turns out there's only 4 now. 1 just resigned, and 2 never did get filled. The 12 of us, plus the 4 governors, meet in D.C. 8 times a year formally, and we talk a lot in between. And in that meeting, we meet for 3 days, and we describe economic conditions in the United States, and then we each recommend around the table what we think monetary policy action should be. In addition to monetary policy, which includes interest rates, our balance sheet, and other levers of monetary policy, we also oversee all payments in the United States, treasury services, cash. You use cash, your money is passed through our vaults at the Fed. The way I got picked, every bank of the 12 banks, every one of them has a local board. The Federal Reserve banks, it's an interesting system. The people in D.C. are civil servants and they work for the government. I don't work for the federal government. I work for the Federal Reserve Bank of Dallas, which is a joint venture between basically the public, and it's owned actually by the private sector, by banks in the private sector. So I was selected by the local board of the Dallas Fed, and I had to be approved, though, by the Board of Governors, Janet Yellen and the Board of Governors in D.C., so I had to interview with both, and that's who chose me.
Okay, explain for us what your job is.
So here's what and I get asked this a lot, like, what do you do? So we have 1,300 people in my district. We have our largest branches in Dallas, which is where I am, but we have a branch in Houston, San Antonio, and El Paso. I'll break it down. We supervise about 650 banks, all the banks in our district. So that's 300 or 400 people do just supervision. We have literally 30, 35 economists at the Dallas Fed. So just if you take the whole economics research department with support, that's 40 or 50 people. We have we have cash services, we have vaults, we have 70 law enforcement people, and a bunch of people working on cash processing. We then have people that are working on lots of technology people that are working on systems either for supervision or payments in the United States or cash or other purposes. And then we do a large amount, which is not widely known, of community outreach. So I'm spending a lot of time out in the community working on convening. We're one of the important institutions in our district, and if CEOs and leaders, including mayors and the governor, want to see people convened in the 11th district, normally I'm going to get that phone call very often and say, you're the one who can call this meeting and people will show up. And we do call those meetings to talk about workforce development, trying to create public-private partnerships, early childhood literacy, which is a critical thing, and get people more involved in it, internship programs for at-risk youth, financial access to financial services. So whatever the burning needs are in our community, we are a very prominent convener, and we write research on it to convene people to do this.
Okay. And I know in jobs like yours, there's no such thing as an average day, but what does your day look like? Maybe tell us about a couple of your more interesting days.
So for me, always, I walk around with a little thought cloud over my head like the cartoon strip, and in that cloud, I'm thinking about monetary policy all the time. You know, in my previous life, I guess I was thinking about leadership all the time. And in my previous life, I was probably thinking about the markets and my clients all the time. In this one, and how to build our firm. But this one, I'm always thinking about what's going on out there, okay? And so I'll get in a typical day. After I have breakfast with my son, I will come in and get in the office by 7:30. And I will they'll usually try to leave me alone for an hour. And I'm just reading. And I've been following during the evening what's going on in the markets. What does it tell me about consumer spending, markets, credit spreads, you name it. Every element that goes into what's going on in the economy. We then are I'm spending every month, on a typical day, I'll talk to 3 or 4 business leaders that run businesses through the districts. I'll often speak every couple of days to a local group, working on supervision issues. Right now I'm working on hiring people, building our team, working on coaching and managing our group in Dallas. And then often a typical day or week will be getting together with a couple other presidents, either by phone or in person, to talk about one of the subcommittees we run. So I'm about to chair the technology committee for the Fed, system-wide. Budget, we call it spending stewardship. I'm about to chair that effort system-wide. I'm on the payments subcommittee for the system. So we're meeting to talk about different issues, different initiatives, things we're trying to do. So that's probably, if that makes any sense, that's a typical day.
Okay. One of the things I'm very curious about is you've written a lot about leadership and studied it extensively.
Yeah.
In going into this role, how have you applied some of the lessons that you learned?
So I'd say if I'd gone straight from Wall Street, I don't think I could have gone straight from Wall Street to this job. The Fed is very much a hybrid. It's a little bit like business, and we deal with businesses, but it's got a heavy dose of academia. It is run heavily by PhD economists. I'm unusual, and I'm one of the few presidents that's not a PhD economist. And so the leadership experience and the experience at Harvard taught me one very important thing. First thing you got to do when you're going into a different kind of organization is you got to first learn what they know. And so the very first leadership lesson I learned, and I applied at Harvard Business School, is get in and learn. I've read every research paper we've written at the Dallas Fed. I've talked to every economist. gone through every theory, talked to people outside the Fed to get their advice. And then the second thing I've learned from leadership is you have to really understand the culture of the organization you're going into. And for those that have worked in the government, the culture of business, it depends on every business has a different culture, but certainly Goldman Sachs had its own culture. Harvard had a completely different culture, and if I tried to manage a senior associate dean at Harvard the way I did at Goldman, they would have killed me. And I tried a couple times, and they almost killed me, and I learned I better back off. Much more participative, you've got tenured, power is much widely distributed, and then Fed has got a culture all its own. And what does that mean? Deeply embedded history, deeply embedded practices, lots of employees that have been there 30 years who know more than I'll ever know, and you've got to show them respect. And you've got to try to learn what they know and ask lots and lots and lots and lots of questions, which I'll never stop doing. So those are some of the lessons I learned.
Okay. What's the kind of the broader role of the Federal Reserve in the overall economy?
Well, so the Fed, at the end of the day, we have some blunt tools, and we do a couple other things that are very valuable. So the thing that gets talked about, and I'll talk a little about the economy in a moment, the thing that gets talked about most frequently is rates. When are you going to raise, what are you going to do with rates, and what are you going to do with your balance sheet? So the Fed funds rate is not the only important interest rate in this country. There's the treasuries, 1 year, 5 year, 10 year, 30 year. There's what we borrow against. Fed doesn't set those rates. We only set the Fed funds rate. And sometimes that affects the treasury curve, and sometimes it can affect it in surprising ways. But interest rates are so critical in our lives, and we set those short rates, so that's a critical element of what we do. We supervise all the banks in the United States with other agencies. That's a critical part, I think, of protecting the country from another crisis, so-called macroprudential tools. You take us for granted in a lot of ways. I talked about if you use a credit card, if you do any kind of payment, electronic, you're working through the Fed. You just don't know it. If you're using cash, eventually we're processing that. You just don't realize it. But I think that one of the most important things we do, which is sometimes misunderstood, and we were talking about it at dinner, is we do research on the pressing economic issues, and we are completely, to the extent humanly possible, apolitical. So, for example, at the Dallas Fed, we're doing research on energy, trade, immigration, as well as monetary policy in the economy, and we publish it, and I'm speaking about it regularly. So I think a big part of what we do is to lay out there, educate the public as to how this economy works, and do it in an apolitical way. And I think that role is more important today than it's ever been.
Okay. One of your colleagues, your colleague in Richmond, had to resign in the last couple days over an ethical concern. And I just wanted to ask the question because a lot of people would be interested in this. What kind of ethical constraints do you have in a job such as president of one of the regional feds?
So I was accustomed to this working on Wall Street, where we dealt with confidential information constantly. And basically you had to guard it with your life because you have a responsibility to guard that information. At the Fed, it's even more intense because we have access to confidential information, but more importantly, the deliberations of the Federal Open Market Committee on which I sit, the deliberations themselves are confidential. If people could sit in those meetings on the outside and know what we were saying, that moves the markets, okay? So this is why you've got to be very, very careful not to disclose anything that is non-public information. And we're also very careful that when we speak to a group like this, we invite the press. But so it's not only the deliberations of the FOMC I keep to myself, and you need a certain level of security clearance within even the Dallas Fed for me to even share that information. And I follow the need to know information. I don't share information with anybody that doesn't need to know. And when I do speak publicly or speak to third parties, it's got to be information that's either been widely disseminated, or I'm widely disseminating it, or I'm not going to tell somebody in a small group anything that hasn't been disclosed publicly. And that's it's critical to the confidence in the Fed. And I've talked a lot, the independence of the central bank is critical to this country, but with that independence goes the responsibility to guard and treat appropriately any non-public or confidential information. And so we take it enormously seriously.
You've been at the Fed a little bit over a year, about a year and a half or so.
Yeah.
What would you say is, if you had to define the biggest challenge that you've had in becoming president there?
So there's the cultural adjustment, but I'd say the most important thing I've learned, I had a view of the economy, and I had a pretty in-depth view of the economy, worked extensively with businesses, I had a good bird's eye view, and I've learned a lot coming to the Fed that makes me realize the economy we're living in today gets talked about as if it's the same 10 years ago, 20 years ago, 30 years ago, but it's not. And I can go through why. There are 4 big reasons why, and I'll just mention what they are. They don't get talked about enough, and I've had to first learn this, and I talk about this a lot. First, big surprise or thing that people underappreciate is aging demographics in the United States. Population of this country is aging. The workforce participation level has been talked about a lot. Was 66% in 07. It's 63% today. But the bulk of that decline, in our view at the Dallas Fed, is demographic. It's aging. And it gets worse. This trend is intensifying, not only in the United States, but almost every advanced economy. And we think over the next 10 years, the participation rate due to demographics in the U.S. is likely to slip below 61%. Why does that matter? GDP, gross domestic product, is made up of 2 things: growth in the workforce, increase in productivity, i.e. increase in incomes per capita. If the workforce is not growing very fast, it's going to be hard for GDP to grow very fast. This is why getting discouraged workers back into the workforce, vocational so-called middle skills training is critical, and this is why immigration plays a big part in GDP growth in the United States. Immigrants and their children have made up over 50% of the workforce growth in this country over the last 20 years, and they will make up more than that in the next 20. And why? Because our workforce is aging. I wish we could stop it. I personally definitely wish we could stop it, but we're not going to stop it, but we have to talk about it. It also means, second issue, we are very highly leveraged at the government level. I knew that before I came into this job. But one of the reasons why not only is public debt held by the government about 77% of GDP, which is historically high, but worse, present value of unfunded entitlements, health care and retirement benefits, the unfunded portion, present value is $46 trillion. Okay, this would be a problem even if the workforce were growing and demographics were better, but it's a real problem. You know, ask cities with pension fund issues when your workforce is aging and the number of dependents is growing, the number of workers per dependent is changing. Being that leveraged is a big issue. Both of those trends create a big headwind for the United States. And we can deal with it. We've got to first talk about it. There's 2 other trends I'll just talk about very quickly.
Please do.
And they're both confused with one another. One is globalization, which we all know about. I mean, the world's got more global, financial markets are more integrated, we know economies are more global, we know the relationship with Mexico is much more today about integrated supply chains and logistics than it is about trading goods. Typical good, of the imports to the United States from Mexico, 40% of the content is U.S. content, which means the goods are going back and forth. And so this trend has taken hold over the last 20 years, and we believe at the Dallas Fed that, for example, the relationship with Mexico and these integrated trade relationships have grown jobs in this country, made us more competitive, and kept us from losing those jobs to Asia. Okay? So it's one thing to add a job here, but it's got to be globally competitive. So globalization is a huge trend, and what's happening is, because it's become, over the last 30 years, many U.S. jobs have been lost, because it's been cheaper to take industries offshore. That trend, I wouldn't say is necessarily accelerating. It might even be ebbing. There was an article in the Wall Street Journal this morning about, or I read, actually wasn't, I read it somewhere else, that the cost advantage China has versus the United States is starting to equalize. So why are we still losing jobs? The second trend, technology-enabled disruption. That is now a bigger reason why we're losing jobs in this country, much bigger than globalization, okay? Amazon versus retail stores. The fact that consumers have enormous pricing power with technology, and that technology is increasingly replacing workers in almost every business we deal in. Go into a store, you go into any kind of business, you're going to be dealing more with technology, less with workers. This is causing a number of problems. One, workers today need to get retrained. They need either need skills training or they need to be retrained, and we're going to need to get much better at it in the United States. That's one issue. The other issue is businesses have much less pricing power than they did, and so to deal with that, they're trying to reduce costs by accelerating using technology and replace individuals. But the net of all this is we're confusing the job losses today from technology and technology-enabled disruption. We're saying it's globalization, it's immigration, it's trade. And the danger of that is if we misdiagnose this, we may actually hurt growth because you could build a shield around the United States. The technology-enabled disruption is accelerating. Driverless car, and any number of trends are going to accelerate it. Even for universities, online learning is a threat, and we know it. And I worked on HBX and every university, Kansas, everybody's worrying about it. We need to beef up vocational training, middle skills training in this country, and we've got to find ways to get people retrained. There's a skills gap in the United States, last point. There is more supply of skilled jobs in this country than there are workers. So we think there are no jobs. There's lots of jobs. Just they have to be workers have to be trained, and you're going to see, I would hope, a proliferation in this country of more middle skills training facilities and public-private partnerships to get people ready to take those jobs. Trade actually could be, and immigration could be part of the solution to help us adapt to this. May not be the problem, and so what I'm trying to do in this job is I did that very quickly, is untangle each of these trends and then try to give advice and share that with policymakers so that we make good decisions. We'll handle the monetary policy part of this, which is why I've been advocating be very patient and gradual on monetary policy, but in order to address these issues, we need smart and intelligent structural reforms and other policies that won't be dealt with by monetary policy. So that's the biggest learning I've got in this job.
Okay. What's the outlook for the U.S. economy, and what are the biggest challenges we face? I guess what you just talked about.
So let's talk about, so the overall long-term outlook is we need to find ways to grow the workforce and increase productivity. That's what grows GDP. And so I'm hopeful that we would do that, and some of the things being discussed publicly will help with that, potential policies, and some actually will hurt that. If you move it more short-term to 2017, the good news is I think the U.S. economy will grow at about 2.25% this year. That's our forecast of the Dallas Fed. That's not great growth by historical standards, but it'll be sufficient to continue to drive out labor slack in the economy, probably drive down the unemployment rate, and probably continue to push inflation a little bit higher. The reason I think, and I'm confident the economy is going to continue to grow, the consumer in the United States is strong. And why do I say that? Household balance sheets are in dramatically better shape than they were, say, 8 years ago. The last 8 years, the household sector has been deleveraging. Part of it is a little bit of debt reduction, not much, and a lot of it is with not growing debt, and incomes have caught up to debt. So household debt to GDP is, let's say it was 100% 8 years ago, and it's down to in the high 70s. Not great, but much better. So the consumer has a capacity to spend. That doesn't mean they will spend, but they've got the capacity to spend. And the second thing that's improving is business confidence, and business spending has been sluggish in the last several years. It's ramping up a bit, and I think that will also help. So I think 17 will be a solid year for the U.S. economy, but I'm more concerned about the out years, that we need to do more fundamental structural things to make sure that we can continue to grow.
Okay. I have one final question, then I'm going to open it up to your questions. So if you've got a question, be thinking about it. We'll talk about it in just a second. But Rob, let me ask one final question. We got a number of students. We have our Hemingway Award winners here. We have our student advisory board members here tonight. Yep. What would you say to KU students who are thinking about a career in business or finance? What advice would you give them?
So we were joking about this a little bit at dinner. I would still go back to basics. The most important subject for me is still English. And by the way, that's been true in every job I've had. It was true at Goldman Sachs, it was true at Harvard, and it's absolutely true at the Fed. Okay, if you can't write or communicate well, that is a critically important skill. Okay, so the second part is find a function or a mission that you love. For me, it was the stock market. It wasn't that I was that enthralled with finance, I was enthralled with markets. But for every young person, I always say, think about when you shined. What do you love? What's your favorite class? Where did you excel? Where were you having a good time? What were you doing? What subjects are you interested in? And then when you graduate, try some things that you think might fit that, and you'll learn about new things. But I think the most important thing for your career is figure out what you love and try to get in the neighborhood of it, the mission, the people, the atmosphere, the function. And then second, you want to do things that are a good fit, good match with your strengths and weaknesses. You're going to always be, starting now, you're going to want to always be able to write on the back of an envelope, here are my strengths, here are my weaknesses. And you're going to keep updating that. And I still do that now. And then the last, you got to practice writing, reading and writing and communicating. Get in front of a mirror. I used to get in an empty classroom. You have to practice. You work on the English skills. Never let that go. And if I had to say a fourth, read the paper every day. I always say to people, Wall Street Journal, New York Times, and anything else you want to read it every single day. You can't compete if you're not informed, and you got to read the paper every day to be informed.
Okay, fantastic. We're going to open it up to your questions and answers. If you have a question, raise your hand. Either Emily or Cody will come by and get your question. Remember to ask one question, no statements, please. One brief question. We'll start
and if the
right
Kansas
here.
City Star is here, the Kansas City Star.
You mentioned automation when you were discussing some of the things that impact the economy, and so I was wondering if you had anything to say about the end solutions regarding automation taking over a lot of the jobs that were previously untouchable, such as stock trading.
So this is one where I'm going to be learning for the rest of my life how far this is going to go. There are some people who I respect a lot who say there isn't going to be enough work, literally, and they're saying we need to consider options like I think Finland and other countries have done about minimum payment. That's possible, but I have a great believer, and I've observed it, the ingenuity of the U.S. citizen to find new products, services, other things. So I actually think we're going to find new ways to provide services, create new products. So what it will mean, though, is if you're a young person, it means you better be prepared. You're going to need to keep getting retrained. I was open to it, but not at the level that I don't know if I was ready mentally to get retrained as often as I ultimately did have to. And I think this next generation is going to have to do it even more because the world's changing in ways you can't predict. And the second thing is anything that involves a relationship with a client, a customer, a person, not going to get disrupted out of existence as long as the product or service is distinctive. And so don't ever give up, or if you find yourself in a job where you're not having any relationships, no external relationships, I think it's really important if you're a business person, get yourself in a position where you at least learn to develop external relations. Those are never going out of style. They're not going away. We're going to need them forever, and so make sure it's a great thing never to lose.
Okay, we have a question back here in the back, and we have another hand up here if somebody to take care of that. But back here first.
Hello, thank you so much for coming to Lawrence. First of all, my question is, with your background at Goldman Sachs and considering that you left Harvard in about 2006, I'm sure it was surreal for you to watch the financial crisis.
It was.
And I'm sure you have a very interesting perspective on it. So I was wondering your thoughts on the proposed changes to Dodd-Frank and other future Wall Street changes in Wall Street regulation.
So we were just also, a lot of these things we were talking about over dinner, but here's my view. I, first of all, think it's very important in talking about Dodd-Frank to segment. I would love to see us segment small, mid-sized banks from big and systemically risky banks. I think there needs to be more tailoring, and I'm a big fan of regulatory relief for small, mid-sized banks. I think they're being a little bit suffocated out of existence, and I think they're critical. Small business lending, serving their community, they play a critical role, and if we don't give them relief, they're going to continue to merge out of existence, and we're not going to have, I think we'll lose something, particularly small business lending and serving communities. I have a different view on the big banks, and I can say this having worked at one SIFI. It wasn't a SIFI when I was there, but it became a bank, then a SIFI, and I was on the board of another, State Street. I think actually the capital and the stress testing requirements on the big banks should be very, very tough. I'm okay if we do a thoughtful review of other regulations that might be unnecessary. Maybe the Volcker rule needs to be reviewed. I agree with that. But I am not supportive of any proposal that is going to ease capital requirements or reduce or diminish stress testing. And why do I say that? Capital alone isn't enough for a bank to know whether it's systemically risky. You got to run a stress scenario. You know, you have a severe downturn, stock market sells off, you have extreme events, and if we had been able to do that stress testing in 2007, we would have seen a number of the big banks had a problem, and they would have had time to correct it and maybe deleverage or get rid of some of their counterparty exposures. And so I think that stress testing is essential and has been a big part of macroprudential regulation that's protected the country, and I would be averse to seeing us lose that.
Okay, we have a question right here.
Would you favor the reinstitution of the separation of commercial and investment banking as was done under the Glass-Steagall Act?
So there may have been a time where I might have thought that was a good thing to do. I think there was a window, brief maybe, but there was a window maybe right in the crisis or right after the crisis where any number of things, either breaking up or restructuring, might have been possible. But I think 8 years out, I think it's not perfect, but I think we have much better capital, we have much better downside protection, and I think the banks are by and large serving, the big banks are serving their appropriate role. And I think my fear is doing that separation now would actually be, if it happens organically because shareholders insist on it, fine. But for the government to insist on it, I fear would be destabilizing and might actually create more systemic risks than it addresses, because we are, these banks have learned to operate this way, and untangling them, my concern is, it's not that we don't have systemic risk, but I think we're managing it in a reasonably solid way, as long as we keep tough capital requirements and tough stress testing. So my concern would be, could you mandate this split up without creating more systemic risk than you reduce? That's my fear. Doesn't mean it can't be done, but I'd rather see it happen organically, driven by shareholders than driven by the government.
Okay, we have a question back here.
To what extent does the Fed monitor or communicate with the White House?
Well, I'll speak for myself, and then I'll speak for what I think Janet Yellen does. there is some interaction which has been publicly disclosed between Janet Yellen and the Treasury Secretary, and I think there's some interaction between the Fed staff and the Treasury staff on certain matters. And the reason I'm very cautious about how I talk about this is we, on the other hand, are very careful to not do anything that would either create political interference in our decision making or give even the appearance that politics or political influence or political pressure is playing a role in our thinking. So it's not that the head of the Fed hasn't met with the president over the history of the Federal Reserve, but you'll notice, I think we're very, very careful. And I think probably the White House is careful, the Treasury is very careful, and I know we're very careful. We will brief elected officials on economic conditions, but we're very careful to avoid interactions that will either create the reality or the appearance of political influence or political pressure or political considerations in our decision making. And that's what comes with being an independent central bank. And I think we work very hard to preserve that.
Okay, we have a question here? Great.
Thank you for being here. You can operate independently and very quickly and effectively. Many politicians want to do away with the Fed or take it over, so you have to run everything through the... How do we avoid that from happening?
Well, I won't speculate on the political pros and cons. I would just say the following as a citizen and now president of a senior official at the Federal Reserve. I think it's been one of the critical attributes and huge advantages among many that the United States has and has had over the last many decades is an independent central bank. There are many decisions we make, including the things we're working on this year, that are not popular. The only thing you can be sure of, based on every meeting, the only thing I can be sure of is there will be a big group of people who think we did the wrong thing. And we have to be professional enough to make these decisions, do it with what's best for the country in an apolitical way. And that's what I mean by independence. And so it doesn't mean there shouldn't be oversight of the Fed. There should be. It doesn't mean we shouldn't re-review our practices. I think we should. But I think it's critical to the United States, and and I think the country's been enormously well served by an independent central bank that that can make decisions without regard to political influence or political considerations. And as you point out, we make a decision at the FOMC when we have that vote on Wednesday midday, it gets executed. And I think in many ways, elected officials and the country have been very well served by the fact that we have the ability to do lots of analysis, agonize, deliberate, and then make a decision and execute it.
Okay, I have a question back here.
President Kaplan, it appears that there may be a debate growing in the Fed about moving away from a specific target on inflation rate and going to more of a bandwidth approach. Are you in a position to comment on that?
Well, so let me be clear. We haven't changed our approach on inflation, and I don't sense that there's a move to change our approach on inflation. And I'll comment why you might have read that, but let me talk about what our approach is. What we've said is we have a 2% inflation target. But what we've said, to elaborate more, is what that means, that target means we don't want to see inflation running persistently below 2% or persistently above 2%. So that doesn't mean you might have a variation over a few months up or down, but we don't want to be persistently running below or persistently running above over a period of time. By the way, for the last 8 years, we've been running persistently below. Okay, and we've taken action to try to get to the target. The reason you might be commenting on that, there has been some discussion whether the Fed should raise its target, and it's been reported in the paper. I personally think a lot more work and discussion needs to be done before we make that decision. I'm not sure I'd be supportive of it, but like anything else, I'm open to looking at the analysis. But right now, our approach on inflation, it's a so-called symmetrical target. It's not a ceiling, it's not a floor. We don't want to run too much above or too much below. And for now, I think 2% is actually, that target is the right level for the United States.
Okay, I believe we have a question here.
You talked about being open to learning lessons. Are there any lessons that you perhaps thought you had learned and made part of your repertoire only to be surprised at relearning them again, perhaps in a different way?
Well, there's lots of things that I thought I knew for sure. I mean, I was sure. I finally figured this out. This is it. And then I realized, oops, no. So I guess the only lesson I keep relearning and learning and learning and learning is don't be so hell-bent sure about it. Be open to learning. And if somebody comes in with a good argument, or you read a good argument, or you see somebody, and I do this all the time on television, who's making an argument I disagree with, I'll call them. I mean, this job, the nice thing, I can pick up the phone and call them and talk to them. I want to hear the argument. Now, I might get off the phone and say, nah, I still think what I think, or I may think I missed something. And I'm conscious of the fact you'll always have blind spots. I'd like to think my blind spots were getting less, but I don't know. You develop new ones, I think, depending on the job. And so, no, what you keep relearning is you better keep learning. And if you don't, you're going to be in a lot of trouble. And so, a little humility in that. I keep relearning that.
Okay, we have a question over here, and then we'll get one right here.
Yes. Would you talk about the difference between how the Fed implemented quantitative easing as opposed to the European Central Bank, and sort of specifically talk about the type of securities that you would buy or not buy?
Okay. So just to explain, so quantitative easing, so historically the Fed has managed monetary policy by either raising or lowering the Fed funds rate. And even the mechanic for that has been altered because of the liquidity out in the market. I don't need to go through that thing. But when rates got to zero in the aftermath of the crisis, the Federal Open Market Committee and the Fed decided we need to do something more, and we can't lower interest rates further. I mean, they could have, but they decided, let's try something new, and they called it quantitative easing. What was that? Went out and bought securities in the market, bought treasuries, and bought mortgage-backed securities. Well, obviously, when the Fed goes out and buys in size these securities, it has an effect on rates. It's a way of basically flattening, and studies have been done, how much did it affect rates, but it lowered rates. Why? Because I think the view was we need to create more stimulation, and there was also the view, I believe, that in the mortgage market, we wanted to help revive the housing market, and if mortgage rates were lower, it would be easier for people to buy homes, and that would be stimulative of the economy. And so we did, the Fed, and there's been a lot of debate and controversy about how many rounds of quantitative easing the Fed did, but it did enough of them that the Fed balance sheet went from $800 billion to $4.5 trillion, which is where it stands today. Now, a couple of 3 years ago, the Fed decided that we're not going to buy any more securities, but we're going to keep the portfolio constant, all right? And we've been saying publicly recently that in the near future, as we make more progress on normalizing rates, we're going to look at starting to let that balance sheet run off. Not by selling those securities, but by letting maturities, just not replacing the maturities, okay? So that's what the Fed's done. Then you go to the European Central Bank, and they've done something very similar. The difference is they got lots of countries, so they bought government bonds, and then after they bought a lot of the government bonds, they went and bought corporate bonds, and they built a very large balance sheet, and now they're starting to slow how much more of this they're going to do. Fed never bought corporate bonds. We're lucky with one country, and we have a big liquid treasury market, but the ECB didn't have that. They went out and bought individual, government bonds, and then they bought corporate bonds. With the same purpose, though, was to try to manage rates and stimulate demand and foster a recovery. And during both of them, both the ECB and the Fed had one thing in common. There was almost no fiscal policy during those 7 or 8 years. So historically, if you had a downturn, you'd have fiscal policy, you might have monetary policy, and they'd work together. Why didn't it happen either in Europe or here? The U.S. government and the European governments were historically highly leveraged to where there wasn't the capacity for fiscal policy. So while it's frustrated people, it's not an accident. Almost all the economic policy has fallen to the Fed and the European Central Bank, and central bankers have been more the center of attention, I think, than even they're comfortable with. I'll say they, now we, are been comfortable with, but it happened because there hasn't been much fiscal policy.
Okay, do we have a question back here? Okay, we're going to take one more question. So if anybody's got one last question, we're going to take this one and one more.
So I have a question that it's probably simple for you, but I don't know where the money comes from for the Fed to do the quantitative easing to where your balance sheet went from one to the next. I've always wondered, where'd you get your money?
So this is what's called in some circles monetizing, if you've heard this term, monetizing the debt, which is a nice way of saying there has been an injection of liquidity or printing money in the system. And this is why for those who think we should be on the gold standard, they'd say if we had a gold standard, you couldn't do that. And for those who don't think we should be on the gold standard, they'd say this is an example why we shouldn't be on the gold standard. You have an extraordinary downturn. You might need to actually create more supply of money than there is backup in gold. And the Fed obviously has done that. But this gave us the flexibility to increase the money supply, create money, in effect create liquidity, inject liquidity into the system. Some people think it went too far, but that's where some of the money came from. Now, normally what happens if a country does that, you would see a severe devaluation in their currency. What's happened instead? Dollars actually strengthened. Why? Because the rest of the world was going through their own challenges, and so the dollar relative to other currencies around the world actually has gotten stronger, despite the fact that we've taken these extraordinary actions.
Okay. Do we have a question here? This is going to be our final question tonight.
Perhaps an unfair question, but could you critique your former boss at the Treasury during the crash in 07 and 08?
Hank
Yeah.
Paulson? So in my previous role as a professor at Harvard, I interviewed Hank many times, I critiqued Hank many times, and in my current role as a central banker, it's not appropriate for me to do that anymore. So one of the things that comes with us saying we want to be independent, I have to avoid. But I would say the following, and I'll do this in an apolitical way. I think Hank Paulson got in a situation where the financial sector was over-leveraged, and worse, estimates are there was about 90 trillion of what's called credit default swaps, counterparty transactions. There was only, by the way, $10 trillion of debt outstanding on the planet. So there were 90 trillion of these counterparty transactions to insure 10 billion, which is a nice way of saying 10 trillion, which is a nice way of saying a big casino had developed, which the problem was every non-bank financial, insurance company, and bank had this exposure. They'd either written credit default swaps or they had bought protection on their investments. And so when AIG, for example, failed, that had written trillions notional amount of this, all of a sudden the government realized if we don't go in and stabilize AIG, you're going to have like a domino effect of all these counterparties that their obligations, what they're owed has failed. They're going to in turn fail to their counterparties. And what they saw was we're going to have a run across the financial system. So they took extraordinary steps with Congress in TARP and other actions, which they knew would be controversial, I assure you. The Fed took extraordinary actions alongside, which have been very controversial, which is how we got to a $4.5 trillion balance sheet. And so my own view is the most important thing about leadership is, I've said where I started when talking about this, think and act like an owner. If I'm working at the Fed, think and act like an owner. If I'm Secretary of the Treasury, I would hope they're going to think and not worry about the politics of it or how am I going to look. What would I do if I'm an owner? What's the best thing for this country? And I am convinced that Hank Paulson and his team, you may disagree or agree with what they did, but they stepped up and did what they thought was right, knowing they would be criticized for it, knowing it would be controversial. And so to that extent, I think Ben Bernanke, Hank Paulson, the people involved, whether I disagree with it or agree with everything they did a great service to the country and acted like leaders. So that's what I would say.
Okay. Rob, thanks so much for
Thank you,
joining us
Bill.
tonight. It's
Thank
been
you.
terrific. I want to thank everyone for coming out tonight. If you'd like to get a copy of Rob's book, you can do it out in the lobby. He'll be signing them. My staff will direct you to where you should go for that. Would remind everybody that we will have the inaugural Elizabeth Dole Women in Leadership Lecture here on Sunday afternoon, April the 30th. Hope you'll join us. Senator Elizabeth Dole will be here to kick off that series. So thank you all for coming out. Thanks for your support of the Dole Institute.